think there are definitely industries that are more susceptible to losses related to earthquake and flood. Again, if you rely upon that piece of property, that piece of real estate to continue to generate income, you're a hotel, a restaurant, and if you weren't able to access that revenue generator, then the top line is going to be impacted. A service-related industry like our office, for example, if this whole building was flooded, we could work from home, we could continue to go through our course of business, pivot to another suite, and pretty easily get back to operations. It would set us back a couple days, but it's not going to impact you the way that, if you were a machine shop and your entire manufacturing facility was flooded or damaged, you would have real impact.
What if there's an earthquake and the street by your business is damaged, so customers can't get to your business, but you yourself don't sustain losses? Is that covered by earthquake, or is that covered by something else?
No, it wouldn't be. Prohibition of access isn't generally covered by a property policy, even if earthquake was the cause.
So like when those floods came and washed out, all that rain washed out the roads up to Idyllwild, and those businesses had like business interruption insurance that covered it, but not flood.
No, acts of God are generally excluded from a standard property policy when it comes to business income. So a road being gone, there's no coverage trigger to your property policy that would trigger coverage on a business income policy. It was the same conversation with COVID, right? Hey, you're a restaurant and there's this global pandemic, but the pandemic itself wasn't a coverage trigger. So even though your business's income was impacted, there has to be a triggered and covered cause of loss, and a pandemic wasn't one.
Interesting.
Yeah.
Yeah.
So, and it has to be a covered loss to your owned property. So fire, theft, vandalism, water damage, flood, earthquake, but it has to be your property that was damaged for business income to be triggered. So if an earthquake shakes down a bridge that feeds you traffic across the San Francisco Bay, if that bridge is gone, that bridge doesn't belong to you, it's not insured by you, so the earthquake coverage wouldn't pick up that business income loss. Flood isn't that expensive, relatively speaking. Earthquake is significantly more expensive than a standard property rate, because the risk of loss isn't, you're not going to lose $20,000 or $30,000 worth of inventory. If the earthquake policy really is triggered, you're going to have an event that shakes down an entire neighborhood, and the losses are going to be really significant. So to pick up coverage where your standard property policy leaves off is generally going to cost more than the property policy itself for your standard causes of loss.